Perfect. Welcome, everyone. Good to see some familiar names on there. We're just going to kick off in probably about a minute or two. I'm conscious that we're logging in during our lunch breaks. So grab yourself a coffee or a drink or whatever it is and settle in. But we'll just wait for a couple more to drift through. And about 3 minutes past, we will kick off. Scott, how's the marathon running going?
I need to get my fitness back up to where it was since the last time I did one.
Are you
But
are you doing six surf this weekend?
I'm not. So I have done that on many occasions, but yeah, this year I won't be doing it. So yeah, give the feet. I was about to say, I probably if I want to do another marathon, I should use that as a way to train back up and get my fitness going again.
Yeah.
So yeah, it's been too much time doing too much tax. I need to get out of the house and do some more running.
Fair enough. Fair enough. Well, I think let's kick us off. I think for anyone that's not here, they'll obviously pick up the gist. But thank you so much for everyone that's joined us. Great to see some really familiar names popping through in the chat. My name's Will, obviously. If you've come through on board in the last year or so with Fox and Hare, we'll have met. So great to see you. For those that don't know, I'm the member success manager, run all the initial consultations for our new members in the partnership side of our business. And obviously one of our partners at Fox and Hare is Beanstalk Accountants, and I'm joined today by Scott Lynch, who's the director of Beanstalk. Hello, Scott.
Good to be here with you, Will.
That's good. It's good. And today we'll be talking through. I'm conscious we've got the challenging task today of making a 45-minute webinar about tax returns and tax. Exciting and engaging, but we'll do our best as we go through. So, for those on the call, what are we really trying to get out of this? Maybe try not to think of it as a tax webinar, but a webinar in which we might be able to save you some money and some key takeaways. I'd really love each of you to come away with just one or two key points, maybe some information that we weren't aware of, for example, deductions that we can kind of take advantage of in that respect and mistakes to look out for. What are we actually going to be covering? How is it going to work? I'm going to be diving into kind of the common mistakes that people make when doing their tax returns. We'll be looking at some common deductions that often go undeducted, which can obviously be used by yourselves to claim back in your final return. And then we'll have a bit of a Q&A towards the end for the last 5 or 10 minutes or so. So I think Liam has kindly set up a little chat here, which will see your questions come through. So if you have one as we're going through this, then please do just put it in as we go along, and we'll try and get to it towards the end. Scott, I think it's probably, without wanting to make this just a presentation in that respect, there will be times where we look at some documents that you've got together, most practically probably looking at what does an actual tax return look like and how to practically make these deductions, for example. But I guess to kick us off, I'd love to maybe start with quite an open-ended question of, what are some of the biggest mistakes that you see people make? And then we can dive into that, as we go in a bit more detail as we go through.
Cool. Yeah, no, so I suppose I'll start on the income side and then we'll go through to the deduction side. But I suppose when it comes to the most common mistakes, um, what people generally find, a lot of people will get very gung ho and they'll want to do their tax return right on the 1st of July or the 2nd of July, and not realize that there's a few bits and pieces that you'll need for your tax return that might take a little bit of time to be ready. So your employer has a little bit of time to get your income statement all finalized and appearing in your MyGov. And so you'll probably want to wait, 2 or 3 weeks after the end of 30 June before you actually start your tax return so that that's appearing in your MyGov for you. As well, your banks, the interest on your bank accounts will appear on your MyGov as well, and the banks have a little bit of time to, finalize all of those details and submit that with the ATO. So we generally kind of recommend, as much as you might be really keen to do it on the 1st of July, maybe wait until at least the middle of the month, until some of those statements on the income side are appearing. And then as well, if you're somebody that has investments, so if you've got managed funds, ETFs, or if you've got employee share schemes or investment properties, a lot of these types of incomes require statements that'll take a little bit longer, particularly on the ETF front. Some of those statements might take until the end of September. So there's no need to rush in and try and lodge it straight away, I think is kind of one of the
Yeah.
easiest mistakes that gets made. And yeah, kind of waiting until you've got all of those documents ready to get going is probably a good way.
Okay, so some key kind of dates for people to be aware of is that although 30th of June is the end of the financial year, you probably, if you've got things like an ETF portfolio, need to wait until the end of September for them to have finalised that statement for you to provide either yourself in your tax return or to your accountant, who will obviously do that for you as we'll break down. What are some other key dates that people need to look out for? We obviously talked about some previously. If you're doing it yourself versus using an accountant, what are those dates that people need to be aware of?
Yeah, so basically the 31st of October is the due date for your tax return if you're doing it yourself using your MyGov account and doing it online. If you engage an accountant before the 31st of October, so you need to be on their tax agent list before that date, you get an automatic extension until the 15th of May the following year. So we're doing their 2025 tax returns. You've either got until the 31st of October this year to get it lodged yourself or engage an accountant. If you engage the accountant before the 31st of October, it's the 15th of May 2026 that you've got to lodge. And one of the benefits of, and I suppose obviously if you're getting a refund, those dates aren't super crucial because you're going to want to lodge as soon as possible and get that money back. If you've got a bill that you have to pay, sometimes it can be beneficial to do it through an accountant. So instead of having to lodge and pay on the 31st of October, you can delay that lodgement and payment until the 15th of May next year.
Okay, so if I've got a big tax bill that I need to pay, for example, benefit of using an accountant is I don't have to pay it all straight away at the end of October. I can wait and either spread it out or pay it at a later date, essentially quite a few months later.
Yeah, that's a good benefit.
Okay, perfect. Let's dive into the practicality of this. So say I'm a member listening to the call and I'm thinking, okay, I'm not going to use an accountant. I'm going to do my tax return myself. Practically, they log into MyGov under the ATO section and then go to their lodgements section of that website to download a tax return. Can you just bring up what that would look like? And then we'll try and break that down as we go through the deductions to try and give some useful tips for these people that would be wanting to make some of those claims.
Absolutely. I'll just a second here while I oh, Liam, I think I'm not able to share my screen. I think I might need you to
I hadn't thought about that.
enable that for me. And then I
All
can
good. All good.
share.
There you go. You should be able to share your screen now. Sorry about
Fantastic.
All good,
All
mate.
good. No stress. So now what I'm just showing here is a sample. Obviously, if you were to go and do your tax return by paper, the very, very old school way, it would look exactly like this. When you're logging in and doing it through your MyGov, it will look it won't look the same, but all of the fields will be exactly the same. It'll just be in a slightly different, it'll look different, but it'll all be in the same format and in the same order. So you kind of put all of your personal details in. You'll put all of your salary and wage amounts in. If you're receiving government allowances or pensions or youth allowance or anything like that, they'll go in there. So this is a full copy of the full tax return where at each of these labels for the different things, say I've got a work-related car expense, you'll calculate what your claim is and you'll put the dollar amount in there. So yeah, this is kind of a what it would look like when you're doing your tax return.
Yeah.
Yeah, that's
Cool. Just on that, I'm conscious. I'm looking at who's in the room and kind of what sort of are we employed? Are we self-employed? And I'm thinking, okay, well, yeah, it's pretty simple if I've just got a flat salary, but how do I report that income if I'm earning bonuses, if I'm earning, kind of vesting share schedules, for example. Can you just talk us through how you would go about implementing that into a tax return?
Yeah, absolutely. So obviously your salary and wage is quite straightforward. It goes in the salary and wage section. If you're getting bonuses, they tend to all be rolled into your salary and wage. So you kind of don't need to do anything different. You just it's as if you got it all as salary and wage. There is a special section for employee share schemes. So if you're someone that's receiving shares in your employer as part of your compensation and they're vesting, there'll be a tax component of those. The other thing as well, so in your MyGov, your income statement from your employer will have your salary and wage amount. You'll get a separate income statement for your employee share schemes if you have that type of income, and it will look like something like this. So you'll have, your employee share scheme statement. It'll have all of the details of what are your different types of breakdowns of all of the bits and pieces. So it'll say, at label F, put this dollar amount, at label C, put this dollar amount, at label E, put that dollar amount. And so you go back to your tax return and you'll come here and you'll say, okay, there's label D, E, and F under the employee share scheme section. And you just copy all of those figures across from that employee share scheme statement. You copy that back across into your tax return. So it should be nice and straightforward for you to be able to, once you've got the statement, you obviously have to wait. They take a little bit longer than the normal income statements. But yeah, once you've got that, it's just a matter of copying those details across.
Okay, perfect. And obviously, I don't want to spend too much time on this, but just a question on if you are self-employed, for example, would there be any difference in how you'd start reporting that income?
So yeah, the self-employed income, so it depends on how it's structured, but assuming that's through like a personal ABN in your own name, you would come through and there is right towards the back of the tax return, there's a section for business income, which is this section here. So business and professional items section, where you'll go through and you'll put, what type of business are you in? Oh, I'm a photographer. And what's the name of your business? Where's your business address? And then it will say, okay, what's your, gross income from your business and all of the different expenses related to that business income. So that'll be where you'd put it in the tax return. It has its own special section for business income.
Okay, perfect. I think that's maybe a nice tangent. Obviously, I don't want to spend too much time on the income side. I think what most people are probably here for is, what can I claim for? What are the bits I'm missing out on? So let's dive into the deduction side of things, because I think this is probably the most relevant for the people in the room. And then we can break down, what are the biggest mistakes that people are making, and obviously what can we claim and what can't we, is something I'm really keen for us to get across. So at a high level, Scott, what are the kind of the easy wins, the common deductions that people make?
Yeah, absolutely. So I suppose one common deduction, if you're a tradie, a common one is you can claim your motor vehicle as a deduction. One of the things to note is that for 90% of people, when you're and I've got a little diagram here of claiming motor vehicle deductions. So anything between home and work, you don't get a tax deduction when you're driving your car. But if you go from home out to a client's office and then into the office, that's both deductible. And if you go from your work out to a client office and back, that is also deductible. The main reason I mentioned tradies is that there is an exemption that you can claim this between home and work trip if you're carrying bulky goods. So if you're a tradie that has a ute full of tools that you can't, carry on the train to get to your work, then you can claim these trips as well. You've got two options to claim car expenses. So there's basically the ATO gives you a standard rate of 88 cents per kilometre. You don't need to do a logbook to be able to claim this, but you do need to substantiate, where you went and how you did those travel kilometers. It can just be something as simple as a calendar appointment in your work calendar. So let's say, for example, if you're a sales manager and you've got to go out and visit a client and you do that once a month, it's a 100-kilometer round trip every time you go and visit that client. You can say, oh, okay, I can claim 1,200 kilometers as my, I go and see this client once a month every month. And then you'll say, okay, 1,200 kilometers multiplied by that 88 cents a kilometer will give you your dollar value for your car deduction. And then you can, under that cents per kilometer rate, you can come back to your tax return and you can put that under work-related car expenses. The other option is you can do a full logbook, document all of your car expenses and all of your odometer readings and say, okay, this percentage of my car use is work-related, and you can apply that across all of your car expenses.
Okay, I'm with you. I'm not sure there's anyone here that's going to be doing that to the kilometre. But I think what is useful to kind of note is that you can't claim it just from obviously your home to the office, but obviously if you're out and around in between offices, that is something that you can claim for as well, unless you are, like you say, carrying kind of bulky goods. Maybe I think that's kind of something that we talked about previously was travel more broadly, not just to and from the office, but a lot of our members, here today would be traveling abroad, for work. How to what extent is that tax deductible? Can you talk us through that?
Yeah, absolutely. So I suppose the way that the ATO looks at that is they look at the predominant purpose of the trip. So let's say, for example, you're going overseas for a conference. The conference lasts for a week, so you've got 5 days of work from Monday through to Friday. But instead of you arrive on the Saturday and you spend 2 days over in, let's say the conference is in Bangkok, just because Liam's over there. That's a good example. Let's say you land on the Saturday, you go spend the weekend touristing around, seeing a bunch of sites. You spend the next 5 days at your conference, and then you spend another, the Saturday at the end of that weekend, traveling around as well, and then you fly back home on the Sunday. Because the predominant purpose of that trip was work related, you get to claim all of the flights, all of the accommodation, and you don't have to apportion for any private use because the predominant purpose of that trip was for work. If you flip that around the other way, and if you're going overseas for a 3-week holiday, and you meet with a client while you're over there, and it's a 1 hour meeting, the predominant purpose of that trip was personal. So even though you met with that client for that 1 hour meeting, you don't get to claim any of the flights or accommodation. So that's kind of, if you're doing international travel, the way to look at it. You're wanting to kind of make any private travel that you're doing while you're overseas kind of incidental to what you're doing. So yeah, weekends either side of like a week-long trip, or if you're over there for 2 weeks, the weekend in the middle as well. The weekend in the middle is absolutely fine.
Yeah.
And then that way you can claim all of your accommodation, all of your flights.
Okay, perfect. So it's the way to think about it really is if it's done on time, if more than 50% of that time that you were abroad was for work, then you can claim that whole trip essentially. But if less than 50% is, then you can't.
Yeah, that's kind of the way you want to be looking at it.
Okay, brilliant. Okay, and what are some other kind of deductions that people can make? I think you showed me a list previously of kind of the most common. Do you mind actually taking us to that document, Scott, where we can see
Yeah, I
what are
can.
the common things that people do? Because I think that would be relevant for everyone that's not just traveling abroad, for example.
Absolutely. So I suppose with clothing, claiming clothing as a deduction, a lot of people mess this one up because I know a lot of people think, oh, dry cleaning, it's tax deductible. It's only tax deductible if the article of clothing that you're dry cleaning qualifies. And the ATO, they don't, this is not an ATO SEF. This is more just like a sniff test that we kind of apply.
Yeah.
Is that if you could wear it outside of a work setting, then it's not tax deductible. That's kind of the easiest way to kind of get at the headspace of what you can and can't claim.
Yeah.
And so like if you think of an occupation specific clothing like judges' robes, medical scrubs, absolutely, that's perfect. A bartender's white shirt, black pants, that's a no. A suit is also a no. Unfortunately, I know a lot of people like to try and claim that, but unfortunately, that's a no. Protective clothing is an easy yes. So steel cap boots, high vis gear, easy. And then as well, compulsory work uniforms. So something that is visibly branded with a company logo that you're obviously not going to wear anywhere else. Perfect
Cool.
example, Will.
I wear this all the time on the weekend.
Or whatever floats your boat. But yeah, that visibly branded company shirts, absolutely. If it's a jumper jacket, but if like my shirt doesn't have a logo on it, so that wouldn't be deductible, even though I am wearing it at work.
Sure.
So that's a common way to look at those deductions.
Cool. I'm just looking at this and I'm thinking, purely from a member's perspective here, obviously not my own, but if I was thinking, okay, at what point is the ATO actually going to call me out on these things? Like how far can I push these, these claims, for example? So one of those for travel, for example, we spoke previously around it's not to do with a base rate for everyone, but more to do with your profession that's going to highlight if you're going to get called out for these things. Can you just use that travel point as an
Yeah,
example of what you mean by that?
Absolutely. So basically, with motor vehicle deductions, I use that as an example. As a part of your tax return, you've got to declare what your occupation is. And based on your occupation code and what that occupation is, they have a lot of data matching, and they basically segregate everyone that lodges tax returns, and then they compare every single person that has the occupation code of X, and what deductions did all of them claim. So say, for example, if you put down, a builder or a plumber or any other trade, and you've got motor vehicle expenses, they're not going to question you too much, because they'll say, oh, okay, well, he's probably got a ute full of tools.
Yeah.
That's fine. If you're an IT person, like you're just working in an office and you've got, lots and lots of kilometers in your car, they'll probably flag that. So it's not necessarily, oh, you've claimed 5,000 kilometers, that's a flag. It's more a combination of your occupation code plus what you've claimed, is what will potentially raise the red flags there. So yeah, it's a little bit tricky to kind of give all of that detail, but that's kind of what the members should be thinking about is, am I in a profession that just sits at a desk in the city and I'm not expected to go traveling? Then that will be a flag. But if you're in a profession where, or like you could be like a sales rep that's required to drive around, and so they would expect that you would have work deductible travel for that kind of thing. So that's kind of how the members can think about it, in terms of where these thresholds kind of sit and where the ATO would, in terms of where their red flags are as well.
Okay, perfect. So really the way to think of it, if it looks, would raise a red flag compared to your profession, then just be careful about how much you're going to push that. But obviously, if it sounds reasonable within that profession, then you should be okay.
Yeah, that's correct.
Okay, perfect. Now, a lot of our members do an aspect of working from home, and sometimes we get questions around, does that make my rent tax deductible? Is the equipment tax deductible? That sort of stuff. Can we talk just a little bit about that? So that we can get some clear answers on what is and isn't deductible for those people that do spend, a period of time at home.
Absolutely. So we'll start with all the equipment side of things, because that's really straightforward. If you are buying work-related equipment, then you can absolutely claim that as a tax deduction. Occasionally you might, if you're doing things from home, you might have to apportion those deductions. So let's say, for example, you buy a computer screen, or you've got an extra keyboard, and that stays at home, and you might use that personally from time to time. So instead of claiming 100% of that, you might claim 80% of it. So there might be some apportionment there. But for the most part, if you are using those things, that's really easy to justify and claim. When it comes to claiming portions of your rent and things from working from home, what you need to, there's a couple of criteria, and the one main criteria is you can't have an office available to you. So if you're voluntarily working from home, let's say your business has an office in Sydney, and you live in Sydney and you just want to do a couple of days from home, you can't claim any of your rent as a tax deduction, because you have the option to go into an office. But let's say your work is based in Melbourne, and you're living in Sydney, and they're wanting you as part of your role to expand the Sydney operations without actually having an office in that city, then you can start to claim a portion of your rent. The way that's done is you need to have a space set aside exclusively for business use. So if you're in a 1-bedroom apartment, you can't claim any deduction. But if you're in a 2-bedroom apartment, you can say, well, that second bedroom is used exclusively as my home office. And then you can say, okay, I've got a 100 square meter apartment. That bedroom is 10 square meters. I'm claiming 10% of my rent, 10% of your electricity, et cetera, et cetera. So that's kind of how you would look to do that. Is that you would want to, first have a space set aside exclusively for work, and then you work out the area. The other thing to note is that you can't claim it's only the exclusive area. So there's no claiming a portion of the bathroom or the kitchen table or the lounge room. Even though you might go to the bathroom while you're working from home, it's literally you can only claim the office space.
Okay, so 2 things there for an example then, because I live in Sydney and our office technically is in Sydney if we were there often, I couldn't claim that because it's there. But for example, Liam, who usually lives in Tasmania, could, because he doesn't have an office available to him. And the obviously thing to bear in mind there is if you've got a massive office or second bedroom that you want to turn into a study, then you can claim it because it's based on the size of that separate space for work, but if it's included with everything else, then you can't.
Exactly.
How is the ATO going to know is probably a question that people are thinking. How are they going to know if that space is a
Well,
portion?
they actually do. They actually do look at all of the domain listings online, and what you'll find is a lot of property agents, when they're listing the places for rent or for sale, have a floor plan
Yeah.
listed on and the ATO is actually using those floor plans that those property agents put up online. And so that's kind of one of those things that, yeah, if you're pushing the boundaries and they can easily say, wait a second, that room's only 10 square meters, that should be 10%, and you've obviously claimed this huge amount, they will, yeah, they're doing a lot with their data matching on that side of things. So it's kind of one of those things that, yeah, use all the tools that you've got available to you. And I think that would be the way to do it. And then I suppose the other thing as well is that's only if you're renting. If you own the property that you're in, technically you can do the same thing, but you wouldn't have rent. You would claim a portion of your interest on your mortgage, a portion of your council rates.
Yeah.
Now, while you can do that, we never recommend anyone ever does, because what you lose the main residence exemption for capital gains tax when you do make that claim, and you're forfeiting a larger benefit than you're gaining in claiming it. So as much as you could do it, we always recommend that you don't, just because of that clawback for capital gains tax.
Perfect. So really clearly, if you rent, then you can have a look at it. But if you own, then it really doesn't make sense to do it because of the opportunity cost of how that's going to affect the capital gains exemption.
Yep, exactly.
Cool. Perfect. I'm conscious of time. We've got about 5-10 minutes left before we go into some questions. So if you are thinking of you as you're watching this, just put them in and we'll come to them shortly. There are three main things I want to tick off between now and then, and that's things like income protection, a little bit on share portfolios and how to kind of claim that. And then super is a big one, obviously, for our members as well. Can we just touch on income protection and how that is tax deductible, essentially?
Yeah, absolutely. So income protection, as long as you pay it personally, you can claim the tax deduction in your personal return. If your super fund pays the bill, the super fund gets the tax deduction. So that's the main thing to note there. The other thing is you only get a tax deduction for the income protection component, not the life insurance or all the other insurances. So you just want to get your statement from the insurer. They give you an annual tax statement that splits out, this is the tax deductible component, this is the non-tax deductible component. So once you've got that document, it makes it really easy to just jump into your tax return. And I believe it's at item 15, maybe not 15, one of these ones further down. D15, there you go. I knew it had a 15 in front of it. That's the item where you put your income protection insurance, once you've got that amount. And then when it comes to superannuation, you've got up to $30,000 a year you can contribute and claim a tax deduction. It inclusive of your employer mandated amounts and salary sacrificed amounts. So if you're on a $100,000 salary, your employer's paid $10,000 into your super, you've got $20,000 left you can do. The main things to be aware of: the cash needs to land in your super fund's bank account before 30 June in order to qualify for the deduction. And you also need to submit a notice of intent to claim form with your super fund. There is a little bit of extra time to submit that form, but we usually just recommend doing it at the same time you transfer the cash, submit that form, and then that way you can guarantee you get the deduction.
Okay, perfect. So I want to break that down into two sections. Obviously, the first of those being if you're making additional contributions. Obviously, we're now into August. So if you're thinking, okay, I'm going to make a deduction now to claim it this year, don't, because you've already missed the missed the boat. But you could do it obviously when you claim next year. In that respect, the second thing is obviously there are a few members in here who are in a really fortunate position to be over cap, going over the cap because their salary is higher than, the 250K salary, which is a really good position to be in with that salary. But what do they need to be aware of? Often I hear in the first consultation, I just got a massive tax bill that I wasn't expecting. Are there ways to avoid that, what we call a Div 293 tax for going over that cap? And if so, what can we do?
Yeah, unfortunately, the government has written Div 293 in a way that there is no way to minimize it other than earning less salary. All of your typical things, like negatively geared investment properties and having fringe benefits through your work, like salary sacrificing through your work and getting a fringe benefits there. They're all added back for Div 293 purposes. The one thing you can do is you can elect to have your super fund pay it for you. So you've got 60 days after you receive your notice of assessment. You can log into your MyGov and basically click a button and say, I want my super fund to pay this bill, so I don't have to pay it personally. And that's usually the way we recommend for people to kind of deal with the Div 293 when they get it.
Okay, perfect. So although you can't reduce the bill that you're going to pay, you can elect to not pay it from cash at the end of the year. For example, if you want to go on holiday instead or do something like that, then you might prefer to have it come out of your super fund, particularly as well if you are already capping it out, then I'm assuming that there's quite a lot of money going into that super fund. So really the fees or that charge may not make a huge difference within that in that respect. So you can't change the total amount, but obviously what we can do is reduce the overall tax bill through things like, obviously we've already touched on income protection. And there's something else there. You mentioned investment properties. That is something that many people, on this call either have or are looking to do at some point potentially in the future. Can you just explain how you use an investment in property at a high level and how that reduces your tax bill?
Absolutely. So what will happen with an investment property? So you'll have extra taxable income in the rent that you generate, but you claim a tax deduction for all of the expenses against it. So you get an immediate deduction for your advertising, strata levies, council rates, gardening, insurance, any land tax or property manager fees. So all of these things you basically claim a deduction against your rental income. You also get a deduction for the interest on the loan you use to buy that property. Just to note, it's not the repayment. So if you're a P&I and $2,000 leaves the bank every month, it'd only be, the $800 or whatever it is the interest component you get the tax deduction for. But one of the benefits of this is that you might, quite often what we see is that you'll have, say, $25,000 of rental income, but you've got $30,000 of property expenses, including that interest on that loan. So that negative $5,000 you've generated in that investment property can offset your taxable income on your salary and wage income, and you get the tax refunded that was over withheld on your salary and wage. So that's how that can help when you've got an investment property. And then one of the things to note is that there are a few things that are not immediately tax deductible. So there are a few things like, buying assets or making improvements to the property or renovations that are depreciable over time, that you can't claim an immediate upfront deduction for. Some things are not tax deductible, so you can't claim any travel in relation to an investment property. And some things are deductible against the capital gain when you sell the property, not immediately when you buy it. Things like buyer's agent fees, stamp duty, and legal fees.
Okay. When you say just on that one, they're deductible over time, what are the timeframes that you can claim for those things? I'm conscious of not making this, I bought the fridge 4 years ago, but like, what does that actually look like in practice?
The ATO has like this, I think it's like a 700-page document that has every single asset listed and the depreciation time frame for them. But like at a high level, if you've got a fridge and it might last for 10 years, you can claim it over that 10-year period. When you do, like say you renovate the bathroom or renovate the kitchen, that's done over a 40-year period. So it kind of depends on what asset it is that's involved. But we've got access to that ATO list, and we kind of go through and work out which asset has got how long to depreciate. We depreciate it over that time period.
Okay, perfect. I think we've covered those things nicely there. If you do have any questions, keep them coming through so that we can address them in a second. The final thing, which I think is relevant for quite a few people here, which we haven't yet touched on, is share portfolios and how to put that into your tax return. ETFs, as I understand it, are one of the more complex investments to put in a deduction into a tax return, because you're gaining income through multiple different entities, through income from dividends, but also the capital gains of the appreciation of those shares as well, and then also from potentially different geographic locations. Can you just give us a high level of the key things that our members need to look out for when they're putting their ETF portfolio into their return?
Absolutely. So each of your ETFs will give you an annual tax statement, and you have to wait for this to be ready. It'll be usually ready around about September every year. And we've got an example here of they were a Fox and Hare client as well. They had their portfolio, and you can see here their ETF statement. It basically says every label and every dollar amount that they need to put in their tax return. So part of the reason why they're a little bit complicated is there's all of these different labels for all of these different types of income that it has to segregate. Here we've got the capital gains tax income that goes at labels 18H and A. So you come through here and you go and find the capital gains labels H and A, and you'll put the you'll just copy those figures across. Likewise with the foreign income at 20E and 20M, you'll put those numbers. So it does give you all of the breakdown of where to put what thing. It's just you need to wait for these statements to be available. So this is for the ETF side of things. So yeah, you'll get a specific annual tax statement from your ETF provider for each one you have. And then as well, there's also, if you have overseas ones, you'll get a slightly different statement. So this is a Vanguard, I think it's VEU. It's just an ETF that's an offshore ETF. Slightly different, and then it doesn't have all of the different breakdowns, but it is in USD. So you'll need to do a currency conversion to basically work out what the Australian dollar equivalent of that $69 in USD is. Right. And you'll need to add that into the foreign income section, which is label 20. So yeah, some of these things you'll need to do a little bit of extra work to calculate the exchange rates and the and the uptick, and then you can put them into your return that way.
Perfect. I look at that personally and go, this is the point where I probably can't be bothered to do all of that. Is that something that a good accountant will do if you
Absolutely.
just ETF form, for example?
We just get you to send all the statements, and then we do all the calculations and the currency conversions, and then we consolidate it all together and put it in. So if you've got 10 different things where you've got to sum them all up together and do all the different currency conversions, we can absolutely do that for you. And yeah, that's a lot of we have a lot of clients that get us to do exactly that for them.
Cool. We're going to go into some questions. We've got about just over 5 minutes left, and I want to cover through a few of them. I've actually got one from the boss that says we get a lot of questions on debt recycling. Can you just explain, to the people on the call what that actually is and how that works in practice?
Yeah, absolutely. So what you're wanting to do is that you say you've got to buy a place to live in. I've got a mortgage against it. All of the interest on that loan is not tax deductible because that's it's a private place of residence. And then you've got an investment property over here, and this loan, you've got all of that interest is tax deductible because it's an investment property. So what you want to do is you want to have this loan with the investments be really, really high, and you want to have this loan for the one that's not tax deductible be really, really low. So what you'll do with debt recycling is you'll say, any excess cash you might be receiving, you'll use that to pay down your main residence loan as quickly as possible. So this one kind of goes to zero, and you're not paying interest that you don't get a tax deduction for. And then you'll say, oh, okay, I've got some equity now in that property. I'm going to borrow against it. I'm going to a separate loan. So it's not going to be commingled with the original one. It's going to be a separate loan. And I'm going to say, okay, I have this extra money, maybe $100,000 or $200,000. I'm going to borrow against my property and buy some shares or buy some ETFs or buy a second investment property. And then that way, all of the interest on that loan can be tax deductible. And what that debt recycling kind of does is that you've paid down the loan, but you borrowed against it to buy more assets. So your debt level is exactly the same. It's just now more of it is you're getting a tax deduction for the interest on more of it. So it's more tax efficient.
Okay, perfect. So in a nutshell, it's a way of leveraging assets that are not tax deductible, i.e. your own home, in order to produce income producing assets in a more tax efficient way.
Exactly. Yeah.
Cool. I've got a really good question here, and one that maybe is more relevant for both of us. It says, financial advice deduction, question mark. Do you want to talk us through how people go about that?
Absolutely. So financial advice fees are slightly complicated when you need to deduct them. So they're broken down into three different components. So you get an immediate deduction in your tax return for specific investment advice for assets you already own. So if you're engaging a financial advisor about, oh, I've got this investment property, or oh, I've got this share portfolio, what do I do? Do I buy, sell, what have you? Immediately deductible fees in relation to that. Ongoing retainers and commissions for assets you already own. Again, absolutely 100% deductible in your tax return each year. Um, if you have no assets, no investments, and then you go and engage a financial advisor and they put together a financial plan, that is not immediately deductible, but it will be deductible against the capital gains you make when you go and actually buy those investments, and then make a capital gain at the end. So let's say your financial advisor says, buy a bunch of these shares. 5 years later, those shares have gone up in value and you sell them and make a capital gain. You can offset that capital gain with the cost of preparing that financial plan. And in the same regard, investment advice in regards to employee share schemes and ESPPs and RSUs, because that's in relation to, employee shares, and any specific investment advice around assets that are not yet purchased. Unfortunately, there is a component of financial advice fees that are not tax deductible. If it's personal budgeting and cash flow, that's not tax deductible. If it's in relation to insurances, it's not tax deductible. And if it's in relation to earning non-assessable income, then it's also not tax deductible. So that's kind of how the financial planning fees work. In most cases, with a lot of Fox and Hare clients, what we see is that they usually fit into the first two categories quite well. A lot of people will come to you when they've got investments or they've got assets and they're like, oh, what do I do? What do I do with this? In which case we get, an immediate deduction for those fees that they're paying. And as well for the ongoing retainers that they might pay to you each month to kind of manage their portfolio. And then as well, if they do like a big financial plan and you say, okay, go buy this, buy this, buy that, we get to claim it as a capital loss against any CGT that they might incur in the future.
Yeah. Okay, great. So even if you're coming on board and it's not immediately deductible, bear that in mind when you sell those assets down the line, they will be. In practice, people to actually claim that back, how do they put that into their kind of their tax return in that sense?
Yeah, so in the tax return, there's two sections. So if you're claiming an immediate deduction, it goes in the same label that the income protection goes into D15.
Yeah.
So that'll be there if it's an immediate tax deduction. If it's capital, you will put it down with. Oh, we've got to find the section again. I think it's in the capital gains tax section under here as a capital gain. Now, obviously, it's not a gain. You're putting it as a capital loss, but it just sits here at 18V and carried forward indefinitely to the future years until you can offset it against those capital gains. So that'll be where you'd put your capital loss from setting up a financial plan if you don't have assets to offset it against.
Yeah. Okay, perfect. So for those people in here listening, you may have already received your Fox and Hare invoice via the personal finance portal, so you can have a look in there and then use that in order to make these deductions for your tax return. If you're not certain around how much of those are tax deductible, just pop your advisor a message in the portal and we'll come back to you to help you to fill this out yourself. Scott, that brings us nicely to our 45-minute mark. I can see someone's got a hand up, but I can't see a question that comes with it. I think as you're the host, we might have time for one more before we pop off.
Absolutely.
You might speak or talk there if you're able to do that.
Yeah. I'm happy to answer another question if they've got it.
Okay. I think someone's got their hand up but haven't answered the question, so I don't think we'll be able to kind of answer that one. But all in all, Scott, thank you so much for talking through that. I think there was some really kind of useful tips, although not every part of that was relevant for everyone. I think hopefully there were some pieces for each person on that call that could take some pieces away. If someone has come away from this and gone, that was really useful, but I still don't want to do it myself, how do they reach out to you, Scott?
You can send us an email. So my email address is scott.lynch@beanstalkaccountants.com.au, and you can send us an email and we can go from there and get you started. We have a nice easy checklist that'll help you kind of as well put all of your documents and details together to send through so that we can get going, and we can absolutely assist you and go from there.
Perfect, brilliant. And for those also here, we will be sending out our own tax checklist, which will be with you hopefully by the end of the week via the portal as well, which will give you, like we said, just some pointers and yeah, a bit of a helping hand towards filling in your tax return. Otherwise, Scott, thanks so much. Liam, thank you for organising. If anyone has any questions off the back of this, please reach out to us via the portal or via email or to Scott. And hope you all have a lovely day.
Perfect. Thanks, Will.
Cheers, team. Bye-bye.
See you guys.